Quick hack for those of you with a mortgage. All right, if you've got someone in your life that you know is the GIC kind of person, and usually the generation above mine, boomers, big fans of GICs, they're big fans of guarantees, they're big fans of certainty. Here's a cool hack to give them what they want and also save you a lot of money in the process. Okay, two parts to this strategy. Number one, you have somebody who is in favor of GICs as a strategy. They're happy collecting minimal interest income on their money, and they're happy to lock it up for a period of time, a year, 3 years, whatever the term is. On the other side, you've got you, and you have a home that you own with a mortgage. And this works best if your mortgage also has a HELOC component to it. So you got a line of credit attached to that mortgage. Most mortgages will have a prepayment privilege provision in the contract, meaning if you wanted to, as a person who pays the mortgage, you have a up to number where you can pay up to a certain dollar amount per year to pay your principal down. You can reduce your mortgage. And if you structured this properly, when you pay down your fixed portion of your mortgage, you free up the space in the HELOC side. Ultimately, if you pay down $50,000 of your mortgage, you should be freeing up $50,000 in your line of credit side. So ultimately, your credit limit is still the same. Let's just say you've got an elderly parent and they're sitting on $100,000 in a GIC earning 4%. That 4% that they're earning, if it's not within a registered account, and chances are it is not in a registered account, that's all taxable. So they're getting paid 4%, call it $4,000 for the year, which is taxable, and they'll have to pay taxes on that gain. They're left with a net of whatever. For the purposes of this conversation, let's just call it $3,000, okay? How's this for an alternative? Instead of them locking their money up for a year, what if they gave you access to that money? You took that money, paid down your principal. So if you had a $500,000 mortgage, now it's $400,000. You freed up a line of credit space. So if and when you ever needed to pay them back, you had the availability to write a check and get the money back to them. And you pay them what they would have earned at the bank. You doing it this way, you're giving money to your parent or someone that you know. They end up with more in the net. On the alternative side, you've reduced your principal by a pretty big number. And so every payment that you've made to your mortgage monthly from that point on, more of it's going towards paying off principal. So you're paying more and more of your principal off. You are fast tracking your pay down of your mortgage because the principal amount is smaller and you haven't changed your monthly payment amount. Simple strategy. It has the effect of basically you earning a tax-free amount because of the savings you're going to be having from what you're borrowing from somebody that you know. Now, trust is a big part of all of this. You need to make sure that you trust whoever is doing this with you, and they need to trust you in exchange. And if they ask you for that money back, you've got to have it available to them. So you can't overspend past your limit. Their money, not yours. If they need money out in 6 months' time, no problem, right? You can just write a check, there's no penalties. So a quick little hack on how you can make a win-win scenario for both you and a GIC-loving fan in your life. Go get wealthed up.